Hello, good afternoon. Welcome to this latest Wealth of Advice market update that we're recording on the 22nd of September 2023. We're recording this update a day after the Bank of England held their interest rate committee meeting decisions yesterday. We were going to record it yesterday morning, but we decided to wait until after that decision had been made. So when we recorded the last update in August, markets had a very poor couple of weeks in the first few weeks of August. Things then picked back up and we had some positive returns come through. Everything again was looking good until we got to the beginning of this week, and then across in the US, markets have fallen over there. Again, fears over what their Federal Reserve might do with their interest rates. Obviously in the UK, we've had a positive reaction to our Bank of England keeping interest rates on hold. The global economic outlook looks better than it was at the beginning of the year. Again, go back to last December when we were hearing stories that the UK was going to have a huge recession, the US was going to have a hard landing, which was a bad recession. But we've come through that and economies have held up and been very resilient. Jordan and Matthew attended a multi-asset seminar recently where we had fund managers from HSBC, Aviva, BNY Mellon and Baillie Gifford all speaking. The overall consensus from the fund managers speaking was that they were more positive about the global outlook than what they were 6 months ago, which is very positive and reassuring. Why are they more positive? Well, if we now look at the inflation charts, both in the UK and the US, this will explain why people are now starting to feel more reassured than they were before. So when we look at UK inflation figures that came through this week, they were unexpectedly better than what some of the analysts and such like were predicting was going to come through. As you can see from the graph there, UK inflation was at 6.7% in August. It had fallen from 6.8 the month before. Core inflation was down to 6.2% from 6.9% in July, which is good. Obviously, we always look at the petrol pumps as we drive past anywhere, and we'll have seen that uptick in petrol and diesel prices recently. So the energy price going up was what people were fearing was going to cause inflation to remain or go higher, if you like. They were expecting inflation to be 7%. So even with all that on board, the core inflation, which excludes volatile things like food, energy, etc., down to 6.2%. But the headline figure, as I say, has come down to 6.7. We need to get that figure below 5, below 4. Obviously, the long-term targets too. I don't know how long that's going to take, but the fact it's coming down, and as I say, as you can see from that graph on there, it was well above 10% earlier on this year, so it is coming down. That's good. The Bank of England have elected to pause their interest rate rises. Again, I think that's good. Let's look at what the previous rises and the effect that will have on the economy and just keep reviewing it. Next time they meet, hopefully keep them on hold again, and then eventually get into 2024, and that's when we might talk about cutting interest rates in the future or whatever, but that will only happen once inflation's under control. So in the UK, when we hear anything on the news about inflation, we're hearing that people are earning more money, so they're going to spend more money in the economy. The rail workers still haven't come to the end of their dispute. There's more strikes planned in the coming weeks. Always seems to be when I want to go to a Manchester United match somewhere that I can't get the train, and that's happening again a week on Saturday. Anyway, by the by, but they're not getting the pay rise because the government believes that by giving them the pay rise, you're fueling inflation problems. So the headline you can see on the screen there might upset a lot of our clients who are already in receipt of the state pension. I think it's absolutely mental that they're keeping with this triple lock and they're going to give people who are in receipt of a state pension another 8.5% rise in April. That's after the 10% rise they got last year. So that's giving more people more money to spend in the economy, which is pure inflationary. I know the argument coming back might be that the state pension was too low, and I hear all that, but to give, as I say, an 8.5% pay rise effectively to people who are retired with state pensions, they're going to spend that, and as I say, it's inflationary. It's a pure political decision in my opinion. Obviously we have a general election coming next year, and I think the Conservatives did not want to upset all of those people who are retired in receipt of a state pension who might be voting for them. So the triple lock is here to stay. For those people who reach state pension age after 2016, pensions likely to go up by £17.35 a week on average. That'd be an extra £900 a year, taking the average state pension for most people to £11,500 a year. Obviously, those people who weren't contracted out of service and such like will get a bit more anyway, but the base state pension, £11,502. The US inflation story is a lot different to ours, in so much as, and this happens obviously an awful lot with US economics and such like, and how their markets do, is that they go into something first and they come out of it first, and the rest of the world's always behind catching up. When you look at the graph that you can see on the screen right now of what their inflation figures have done, you can see that their inflation almost breached 10% back in January, February time, and then since then you can see on the blue line it's come right the way down. So they've now got inflation to around 3%. Bear in mind their long-term target is 2%. But interestingly, if you look at the black dots, the black dotted line there, they rose interest rates like we did. They now have interest rates above 5%, but their inflation is down to 3%. So they obviously believe they're on the right track. Markets this week in the US have fallen a little bit this week because there is this fear that the Federal Reserve in the US are going to raise interest rates again because they don't think they've yet done enough, which is a bit of a skeptical view. During the last Federal Reserve Committee meeting, the Jackson Hole Summit, as they called it, they said that the inflation remained too high and the Fed was not done in its fight against inflation. And that's why, as I say, markets have been choppy again over there. Chairman Powell had said that they are navigating by the stars under cloudy skies, which when you hear the people who are in charge of their situation talking that, you think, geez, just speak English to people. But what they're saying is they recognise that the economic data is uncertain and we might not yet be through the worst of it. But, as we say, fund managers out there believe we are through the worst of it. And just to look at that graph that we had on there, showing that interest rates in the US is now higher than the rate of inflation. That's what we want to get to in the UK. We've paused our interest rate rises in the UK, and I'm believing that's because the anticipation is in the next month or the next quarter, our inflation figures start to drop, and once we can get our interest rates above the rate of inflation, then hopefully we're there on the track to be job done. So when we look at the following charts on the screen now about US inflation over year to date, the first chart, which compares all items and then all items less food and energy, you can see it's a similar situation to what's gone on in the UK. Overall, it's come down, but there's certain parts of it that's pulling it back up, like we have what's going on here in the UK. The next chart, the interesting one, I think, from an interest rate point of view, you can see that the US interest rates going back to 2020 were at 0.25%, and then, as I say, when we got to March 2022, they increased them to 0.5%, and then we saw those increases. This next chart on the screen shows you how aggressive the Federal Reserve were right at the beginning of increasing interest rates by 0.75% on 4 occasions. Then they increased it by 0.5% in December 2022. We then have had 4.25% increases so far in 2023. And as I say, we're hoping that the Fed has paused. They had an interest rate meeting only a couple of days ago where they didn't raise interest rates, but now what we're looking at is what's going to happen by the end of the year. And as I say, inflation is still the biggest story in town. Let's get it under control, and then markets will increase from here. So when we look across at the US and we look at how markets perform, as I say, we've said many times that what goes on in the US, positive markets over there will help markets around the rest of the world grow. We have a general election coming up in the US in 2024. As many people watching this know, I do like taking holidays across in Florida, so it's always good to speak to the people over there about what's going on. And it does feel like now it is going to be another fight between Biden and Trump. Lots of people will immediately say we don't want Trump back in power, but when you look at President Biden, who's 80 years of age, who looks on occasions that he's deteriorating, you just don't know what's going to be best for the future. But just looking at purely from a selfish point of view, how it affects markets, the chart you can see on the screen shows how the S&P, the main stock index in America, if you like, has performed going back to 1972. And there's only been 2 elections over that period where markets were negative. 2008, the glaring obviously one, minus 37%. That was the global financial crisis. The year 2000 was -9, just coming off the back of the dot-com bubble bursting in 1999 when all the big technology stocks collapsed that year. The previous ones was 1940, obviously World War II was imminent, and 1932, you were still coming off the back of the Great Depression. But in more recent times, what you can see there is the S&P does very, very well in an election year. So this is part of my confidence as well as to why 2024 will be a good year for markets. If you look at the performance of the different portfolios that we invest clients into, I was just looking at this announced this morning the moderately speculative portfolio that we have a lot of clients invested into is on course to do 6% from January the 1st, 2023 to the end of the year. If we can get 6% this year, then we'll look at what can go in next year. This is a definite pull factor as to why markets might be positive next year, because the sitting president obviously will want to be re-elected. They will throw lots of money, tax cuts, other things to get re-elected, and markets tend to do well every year. We then look at how the S&P has done on average over the last 40 odd years. We've got to go back to 1980 there. So the data up to the end of August is showing the S&P was up 14% year to date, but the average return of the S&P over the last 42 years is up 10% a year on average. Most fund managers right now, our model portfolios, the Royal London portfolios, have more invested in this index than ever before, and it's because the biggest and best companies are now invested on the US stock market. There was a UK technology company who went to launch its shares on the stock market for the first time a few months ago. It decided to pull from the UK stock market and went to America instead. I think that listing was about a fortnight ago, and they were up something like 30% on the day they listed, valuing the company at billions more than what it would have been if it was on the UK market. So this is why there's so much importance in this market, because quite clearly it is the most important one. So now we come to the part of the presentation where we look at market performance. As I say, I remember doing this update at the end of July. We'd had a positive June, positive July, and I was really happy with how things have gone. But you can see on this chart here from the 19th of June to the 19th of September, so the last 3 months, S&P's up 4.39, MSCI World Index is up 3.4, and the UK FTSE's up 2%. Nowhere near as good as what it could have been if you look at where the spike got to. Only last week, we've seen some come downs in the last week. There's still a lot of volatility, ups and downs there. Markets do feel calmer right now, however, but there is things that are swaying them on a daily basis. Still, we're still in that kind of paranoid sort of area where some negative news comes through and markets react in a negative fashion. If we'd had the crystal ball on the January the 1st, we could have put every client 100% into the Nasdaq, the by far the riskiest market index out there. That's up 35% year to date. Obviously, we wouldn't do that because that's all our total risk. When that market falls, it falls significantly. But if you look at everything else below, you've got the S&P 500, 13% on this chart. As I say, it was almost 14 on the one we showed, so it is correlating. MSCI, the Nikkei, which is the Japanese one, MSCI Europe, FTSE 100's third off bottom there. Worst performing one is Asia and emerging markets, while we're still waiting for China and unlocking its population from the lockdowns that they had to really come back and emerge. There's been some negative stories from that part of the world in the last few months, but again, let's get into 2024. You're a full year after, of China coming out of its lockdown, and you would hope that that one comes up as well. So I am, as I say, as ever, more positive now than I was, like all of the fund managers said 6 months ago. But with that caveat that, as you can see, when we look at this performance over the last year, that volatility still exists. And if you look at the performance over 1 year, FTSE 100, best performing index, S&P, almost getting close to it. Look at it over 5 years, and the S&P, as I say, up 72% over 5 years. And we think that's the place to be in the near future and the long term, actually. And that's why the portfolios are being geared like that. As I say, Royal London, Prudential, Legal in general, whoever offers multi-asset portfolios is certainly constructing their portfolios to reflect this. So as ever, stay invested for the long run. The returns will come. And hopefully we see the volatility dissipate and go down in the coming months. So thanks for listening to another Wealth of Advice market update recorded at the end of September. Obviously we'll be back again towards the end of October unless there's something comes out where we need to record one sooner. But if anyone needs to get in touch, give me a call, drop me an email, get in touch with your regular advisor, point of contact, and we're always here to help. Thank you.